Chapter 4: Credit. What is credit? On your path to financial freedom, the first roadblock that you may encounter is credit. Whether that's getting your first credit card, buying a car, or purchasing your first home, you will most likely need credit. Put simply, credit is your ability to buy now and pay later. I used to have a joke I would use anytime someone would ask me to buy something. I would respond, "Sure, I'll buy. You pay." Everyone would look confused at first, but eventually they would get the point. Buying and paying are two different things. Credit will allow you to buy, and use your credit to pay. As you can imagine, there are benefits to being able to buy something, even if you don't have the cash to pay for it. With that said, nothing in life is free. Using and managing credit takes discipline. Always make sure you understand the terms. Not knowing when and how much you will have to pay later can be a costly mistake. It is already hard enough to obtain credit, and it takes work to maintain it. Unfortunately, it is easy to lose, so understanding how it works is a major key to credit success. What is your credit score? They say numbers don't lie, and when it comes to your credit score, the numbers won't try. Put simply, it is what it is. If you have a 500 credit score, you can't tell the bank it's because you lost your job or your cousin stopped making payments on that Dodge Charger you co-signed for. The only thing you can do is fix the issue, and to fix the issue, you must understand how your score is calculated. Your credit score is calculated based on 5 key things and can range from 300 to 850 points. The 5 key things are your payment history, 35%, how much money you owe, 30%, credit history, 15%, types of credit, 10%, and how much of it is new credit, 10%. Each one of these factors will play a role in your current credit score. Improving each of these areas can also help to improve your score. With that said, here are some steps you can take to improve your credit score. 6 steps to improving your credit score. Number 1. Get a copy of your credit reports. This may seem obvious, but you would be surprised how many people have never pulled their credit reports. Some people are also surprised to know they have 3 credit reports. That's one for each of the 3 credit bureaus, Equifax, Experian, and TransUnion. You can get copies of all 3 credit reports free of charge at annualcreditreport.com. Before you can fix your credit, you must know what is on your reports. Your credit reports are a record of your payment history, account balances, credit history, and credit inquiries. Make sure you review everything on the reports and ensure they are accurate. Errors on your reports can lower your score, so it is very important to get this information removed. Number 2. Dispute credit report errors. If you find errors on your credit report, you should dispute it with the credit reporting companies, Experian, Equifax, and/or TransUnion. Under the Fair Credit Reporting Act, credit reporting companies must investigate the dispute within 30 days. If the investigation is not completed or the creditor fails to respond within the 30 days, the information must be removed. Disputes can be filed online. Your dispute should explain in writing the error and include copies of documents that support your dispute. Disputing and removing derogatory credit information is one of the quickest ways to improve your credit score. Number 3. Make your payments. As we discussed earlier, your payment history makes up the largest part of your score calculation. This means 35% of your credit score is determined by whether or not you are making your payments on time. Late payments can destroy your credit score. If you are behind on payments, you must work to get them current. If your payments are current, do whatever you can to keep them current. If you have a hard time remembering due dates, I recommend using some sort of autopay to ensure you pay on time. If you have a credit card debt, make sure you are making at least the minimum payment. Simply making your payments on time will greatly improve your credit score. Number 4. Keep your balances low. The amount of money that you owe is the second largest factor in determining your credit score. This is called your credit utilization, and it makes up 30% of your credit score. Credit utilization takes the total credit you have available and compares it to how much you are using. You can calculate it by dividing what you owe By your credit limit. For example, if your credit limit is $1,000 and you have spent or owe $500, your credit utilization is 50%. Having a utilization percentage over 30% can begin to hurt your credit score. That is why it is never good to max out a credit card, especially if it is your only credit card. With that said, if you have high balances, you must find a way to pay them down. Even better is to not create the balance in the first place. Being disciplined with your spending is important, and you should always try to pay off your balances at the end of each month. This will ensure your utilization stays low and can also save you money on interest. Number 5. Credit inquiries. Applying for new credit will create a hard inquiry on your credit report. Hard inquiries make up 10% of your credit score, and too many inquiries can decrease your score. Be disciplined when applying for credit. The 20% discount to apply for a new credit card could decrease your credit score. Number 6. Patience and discipline. Patience and discipline isn't used to calculate your credit score, but you will need it to fix your credit. There are no shortcuts when it comes to improving your credit. Credit repair companies and credit gurus aren't doing anything you can't do for yourself. Be cautious of people who tell you they can fix your credit for a fee. You may be better off using that money to make a payment or pay down a balance. Benefits of good credit. Good credit can make your financial life easier. Good credit can help you get a mortgage, an apartment, or a car. Good credit has lots of benefits, but the most important one is that it can save you money. I like to say, good credit is like having a financial easy pass. It will allow you to travel the financial highway without having to stop to pay the tolls. But when we are talking about credit, the tolls we are talking about is the interest or the interest rate. Interest is the toll for borrowing money. The better your credit, the less interest you will pay. The less interest you pay, the more money you will save. 3 ways your credit score saves you money. Number 1. Lower interest rates. The number 1 way good credit saves you money is with lower interest rates. Let's look at a real-life example of how good credit and lower interest rates can save you money. Let's say you apply for a 7-year, $25,000 auto loan. Having good credit could qualify you for a 3.5% interest rate. Your monthly payment would be about $455, and you'd pay $2,300 in interest over the 5 years. However, if you have bad credit, you could pay a rate closer to 13.5%. At this rate, your monthly payment would be around $575, and you'd pay $9,500 over the 5 years. So with good credit, you would save almost $125 on your monthly payment and $7,200 over the 5 years. That's a lot of money to save for the same car and just for having good credit. Number 2. Credit card offers and bonuses. Once you establish good credit, you will begin to qualify for special credit card offers and bonuses. One of my favorites is the 0% interest introductory offer. I wouldn't even apply for a credit card that didn't have a 0% interest introductory offer. With this offer, you don't pay interest on charges for a set period, sometimes a year or more. You have to make sure to pay off the balance before the end of the 12 months. But for a year, the card is interest-free. I like to do what I call a credit card relay. I will pay off my balances right before the end of the interest-free period and then apply for a new card that offers 0% interest. Using the credit card relay, I haven't paid interest on a credit card in over 10 years. Remember, you have to pay off the balance before the end of the interest-free period. If you are not disciplined with your spending, you could be on the hook for interest on any balance that's remaining. Cash bonuses are another way to save money on credit cards. For example, I have received offers for a $200 bonus for spending as little as $500. That's a 40% discount. For example, your cell phone and cable bill may be almost $500. You could pay them both with the credit card and get a free $200. Just like the 0% interest introductory offer, I rarely apply for cards that don't include some sort of cash bonus or rewards. Number 3. Bank account bonuses. Just like credit card bonuses, banks will offer you money just to open an account with them. I recently received an offer for $325. The only requirement was to set up direct deposit for 90 days. Most employers will allow you to have direct deposits to multiple accounts. If you don't want all of your money to go to this account, just set it up so enough of it does to qualify for the bonus. After you receive the bonus, you are free to close the account and pursue the next offer. You could easily receive $1,000 or more over the course of the year doing this. However, there are only so many banks. Once you have received a bonus from a bank, they may make you wait at least a year before you can receive another one.